Dividend investing is a great strategy to build wealth. If you find great companies with a high dividend rate and increasing dividend rate going forward, you might actually beat most of the professional investors. But where do you find great dividend stocks? If you Google dividend stocks, most of your results will be for shares with just 2 or 3% dividend yield. Not exactly inspirational. But what if we told you that we have found a new asset yielding 17%? Yes, you heard correctly. 17%. Today we will introduce this new asset, explain how it works, the pros and the cons, and whether or not you should include this asset in your portfolio. So stick around to the end. This is investing in a nutshell. If you Google US dividend stocks, you will get a lot of suggestions for great dividend companies. Some will recommend Coke, others Verizon or Texas Instruments. But when you look at the dividend yields, most of these companies will have somewhere between 1.5 and 4% dividend yield. To be fair, most of these companies are also what's known as dividend aristocrats, with a long track record of increasing the dividend yield every year. As we described in our video, The Power of Dividend Investing, the double snowball effect, you need to consider the dividend rate, the dividend growth rate, and the share price growth rate for any given period to get the full picture. When we stumbled upon this new asset with 17% dividend rate, our first thought was that this is too good to be true. As an investor, you should be very careful whenever you think something is too good to be true. And make sure to do proper research in order to verify any of your assumptions. We have done our research and found both pros and cons with this asset, but the dividend rate seems to be reliable. It's time to reveal what this new asset is. It is Simplify Volatility Premium ETF, with ticker symbol SVOL. If you search for SVOL, you will easily find that it had 17.67% distribution yield as of March 31, 2023. It also provides a description on how it works. The Simplify Volatility Premium ETF seeks to provide investment results before fees and expenses that corresponds to approximately 1/5 to 3/10 the inverse of the performance of the CBOE Volatility Index Short-Term Futures Index, while also seeking to mitigate extreme volatility. That is a mouthful. What does it actually mean? We've done our research to understand how it works, and SVOL basically implements two strategies. Strategy number 1. Bet against high volatility in the stock market by shorting the VIX. The VIX is also known as the Fear Index and is a real-time index that represents the market's expectations for the relative strength of near-term price changes of the S&P 500 Index, SPX. In simple terms, it generates a 30-day forward projection of volatility. Volatility, or how fast prices change, is often seen as a way to gauge market sentiment, and in particular the degree of fear among market participants. SVOL's first strategy is therefore to short the VIX, and therefore bet that the market will have low volatility for the next 30 days. This strategy will generate high profits if the volatility doesn't spike, and this is the driver behind SVOL's dividends. But it can be catastrophic if the volatility does spike, which brings us to strategy number 2. Strategy number 2. In order to avoid significant losses if the volatility spikes, SVOL has implemented a hedge. Hedging is a risk management strategy employed to offset losses in investments by taking an opposite position in a relative asset. SVOL has done this by investing a small amount in a deep OTM call option on the VIX. This is a trade that most of the time will be worthless and drains the profits from strategy number 1. But this trade will be profitable if the volatility does spike, and is therefore a great hedge for strategy number 1. To sum up the investment strategies used in SVOL in one sentence, SVOL makes money by betting that the stock market will have low volatility and has measures in place to limit its losses if the bet goes poorly and the market has high volatility. We know that SVOL has a 17% dividend rate, but how does this company compare to an investment in an index tracking the S&P 500? Or a dividend-focused index, like SCHD. SVOL was created on May 13, 2021, and has just a 2-year track record. Assuming a $100,000 investment on July 2, 2021, we have the following results from SPY, SCHD, and SVOL. assuming we always reinvest the dividend. Firstly, our trusted index following the S&P 500, SPY. Our initial $100,000 investment will provide us with 237 shares. Over the next 22 months, we will receive $2,612 in dividends. The dividends will allow us to buy 7 more shares, and we end up with 244 shares and $75 cash. The ending balance is $100,757, basically flat with just a 0.7% increase in this specific time period. Let us then look at SCHD. SCHD is a dividend-targeted index fund targeting the Dow Jones U.S. Dividend 100 Index. Our initial $100,000 investment will provide us with 1,390 shares. Over the next 22 months, we will receive $6,226 in dividends, more than twice that of SPY. The dividends will allow us to buy 86 more shares, and we end up with 1,476 shares and $14 in cash. The ending balance is $104,819, nearly 5% increase and an overperformance compared with SPY in this time period. This brings us to SVOL. Our initial $100,000 investment will provide us with 4,774 shares. Over the next 22 months, we will receive $34,348 in dividends, a staggering amount compared with SPY and SCHD. The dividends will allow us to pick up 1,658 more shares, and we end up with 6,432 shares and $15 in cash. The ending balance is $140,104, a whopping 40% increase, and a significant overperformance compared to SPY and SCHD. Note that SVOL's overperformance comes from the dividends, and from reinvesting the dividends providing even more dividends. If we just look at the underlying share price, SVOL is down almost 20% in this time period, while SPY is down 5%, and SCHD is down 7%. So what's the catch? There are obvious pros with SVOL, but what are the cons? Firstly, SVOL has a short history, and during this time period, the VIX has not had some of the insane spikes that do occur during periods of severe fear. Their hedging strategy works well on paper, but there is no guarantee that it will work as intended before it is tested in practice. Secondly, SVOL share price is slowly losing its value. As mentioned, it has dropped 20% since July 2021, and it has done so with a slow but steady decline. The share price has a low volatility, which is great, but it is not great to see the underlying value decrease over time. SVOL still performs great with dividend reinvestments, but it is not necessarily a great investment without dividend reinvestment. This all leads to the million-dollar question. Should you include SVOL as part of your portfolio? We believe it has a place in a diversified portfolio, but we don't think it should be the only asset in your portfolio. Depending on your investment profile and risk tolerance, it can work really well with 5 to 20% of your portfolio invested in SVOL. You can then use parts of the dividends to keep the weight accurate and invest the remaining in your remaining assets. Note that you always have to do your own research before investing. We are not financial advisors, and this is not investment advice. Thanks for watching. See you in the next one.